How to set up a Roth IRA with Vanguard. While a SEP takes the form of an IRA, employees still can set up their own IRAs. However, participation in the SEP will cause deductions for contributions to the IRA to be phased out for participants with adjusted gross incomes above certain levels. Employer contributions are excluded from the employee's gross income and are not subject to employment taxes. Elective deferrals and salary reduction contributions are also excluded from gross income, but they are subject to employment taxes. Contributions must not discriminate in favor of highly compensated employees. Not more than $230,000 of compensation may be taken into account. This amount is indexed to inflation. Disadvantages. Possibly the biggest disadvantage of the SEP is the required inclusion of part-time or seasonal employees, those short-term employees who provide the least contribution to the company's success. Also, the employer should be made especially aware of the SEP provisions relation to vesting, withdrawals, employee coverage, and the tax consequences on distribution, all of which are separately discussed below. IRS Model SEP Agreement. The IRS model from 5305 SEP may be used by employers in establishing SEPs. However, employers who currently maintain any other qualified plan or who have ever maintained a defined benefit plan may not choose from 3503 SEP. The advantage of using the model from is that the employer is assured that the SEP meets applicable requirements without the need for an additional ruling opinion or determination letter from the IRS. Use of this from simplifies ERISA reporting and disclosure requirements. Basically, all the employer has to do is to provide copies of the completed form to participants and statements showing contributions made on their behalf. Full vesting and withdrawals. All employer contributions to a participant's IRA are fully vested. The employee takes immediate ownership and may withdraw the contributions at any time, but subject to income tax and a special penalty tax on a premature withdrawal. Employer deductions. The contributions made by the employer under a SEP are deductible for the year in which they are made. The amount of the deduction is limited to 25% of compensation paid during the SEP's plan year. An employer may use its taxable year for purposes of determining contributions to a SEP. The excess of the contribution over the 25% limit is carried forward and deductible in future tax years in order of time, subject to the 25% limit in each succeeding tax year. SEPs for persons past age 70. A sole proprietor, partner, or corporate employee who is past the age of 70.5 may enjoy special benefits through SEPs because SEP contributions may be made even after he or she reaches that age. However, where the SEP holder has reached age of 70.5 at the time the contributions are made, distributions must commence at that time. The SEP holder may stretch out the payments by using the Uniform Lifetime Table under the final regulations governing minimum distributions. Under the Uniform Lifetime Table, an individual's life expectancy from year to year and never reduced by a full year. Therefore, SEP distributions may be stretched out far beyond the individual's life expectancy as computed when distributions first commenced.